Good afternoon and welcome back everyone to the second episode of our November trading summit on your core option strategies. And today we're going to be focusing on a single option strategy that just about every single investor, whether you are an options trader or not, even if you're just a long-term investor in stocks or ETFs, you should learn this one strategy that can help you supercharge your portfolio with income using this one single option strategy. It is the option strategy that every single person who has an options account is approved for trading. It is arguably the least sexy of option strategies, yet it is the strategy that many investors overlook. And I think the reason that's being overlooked is for a couple of reasons. One, I think most investors don't realize just how much income they are potentially giving up by not pursuing this strategy. And number two, usually a lot of investors that I've spoken to that say they've sold cover calls before, but no longer do it. It's because they've had a bad experience. A stock that they own got called away. They didn't want it to get called away. Essentially, the trade-offs that they have to make for that income they felt were not worth it. So when you think about the fact that it requires a fair amount of work to manage these types of strategies in your portfolio, and that when you feel that the trade-offs are not worth the gain, that's when I see a lot of traders give up on this particular strategy. And that's what I hope to overcome during today's session, is a clear understanding as to how to use this strategy, how to minimize the trade-offs, and then more importantly, how to automate as much of the steps as possible for your own portfolio so that you can reap the benefits of the income generation without all of the work, and knowing that you are doing the right thing with regards to minimizing any trade-offs that you have to make with this strategy. So let's go ahead and get started. And reminder for those of you that are joining OptionsPlay or OptionsPlay's Thursday education sessions for the first time, we do these sessions every single Thursday to help empower you to trade sustainably and confidently. Our goal here during these Thursday sessions is to make sure that you have the knowledge, specifically knowledge that's going to help you grow your account consistently and profitably over the long run. And income generation is at the foundation of being able to consistently grow your account. Tactical trading, directional trading has a time and place in your portfolio, but the foundation of growing your account in the long run consistently, month after month, year after year, comes from some of the foundations you're going to learn during today's session of how do you generate at least two to three times the dividend yield you currently own on your portfolio through other strategies such as covered calls. Now, before we get started, what we are going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any of the specific securities that I'll be using as example purposes during today's session. So I'll start off today by talking a little bit about what's my goal for today's session, because every single every single viewer who currently has a stock or ETF that you have in your portfolio that you're owning perhaps for the long term, you think is going to appreciate in value in the long run, this is really a strategy that you should be learning how to master for your portfolio so that you can generate portfolio income. We'll specifically talk about what that means, how much income you can expect from this type of strategy. Then we'll dive into the basics of what a covered call is and best practices if you're brand new, and talk a little bit about how do you select expiration dates and strike prices that minimize the trade-off of covered calls and maximize the income generation and maximize the capital appreciation of the stock ownership or ETF ownership that you have. And then I think more importantly, what I want to show you is how you can automate the steps that you're going to learn today, because we are all short on time. We understand some of the benefits of these types of strategies. Some of you already well understand the benefits of these strategies. Some of you might even understand the best practices, but you might be short on time on implementing it. So today I want to make sure we spend a good amount of time talking through the implementation phase so that you can actually take what you've learned and apply it to your portfolio. We're going to go through some examples here at the end. And like I said, through the examples, you're going to see just how much income you can potentially generate off of these strategies. And at the very end, we'll open this up for Q&A. But the primary thing that I want you to take away from today's session is a clear understanding as to how can you generate consistent income in your portfolio utilizing options. And like I said, this session is specifically for one single strategy. It's for a cover call. It's not a particularly sexy strategy, but it is the strategy that should be the foundation of your options trading, your options knowledge. It's where you need to start if you're starting out with options trading. If you're trading options for more advanced strategies, this is the absolute foundation that you need to know, because it teaches you all of the basics that you need to know about an options contract, how option prices change over time as the stock goes up and down and time approaches expiration. All of those things you learn through the cover call strategy. So it's incredibly useful for just about everyone to have in their portfolio and to use the strategy so that you can utilize it not only for income generation, but also help you build the foundations for future option strategies. So the primary question that I get for a lot of these sessions to start off with is, do we record these sessions and can you get access to the slides? And the answer is yes to both. Not only can you get the slides and the recording, you can also follow along with us on the platform that I will be showing you to automate what you're going to learn here today. That is all available to you if you currently have an OptionsPlay membership. You have access to the recording, the slides, as well as the platform. But if you're joining us today for the first time here at OptionsPlay, sign up for a free 30-day trial using the link either we posted in the chat window, or simply point your phone to that QR code on the screen. It takes 10 seconds to sign up. It's free. There's no credit card required, and it gives you 30 days of access to our platform that we're going to show you here today. And we'll send you the recording and slides for not only today's session, but the full trading summit for the month of November, so that you can make sure that you are up to speed on option strategies to help you build your options portfolio. So like I said, point your phone to that QR code or click on the link in the chat window, which Philip has gracefully added into the chat window for everyone to simply click on. Okay, moving on. So let's talk a little bit about who this webinar is for. Now, options trading is a pretty diverse group of strategies, meaning there's lots of different option strategies, low risk strategies, high risk strategies, directional strategies, neutral strategies, bullish strategies, bearish strategies. There's just about every single possible gamut, every single possible outlook you have on the markets or a specific stock, there is an option strategy for. So the question for a lot of investors is, who is this specific strategy for? When we talk about your portfolio and we look at portfolio allocation, we typically see, roughly about 20% of your portfolio tends to be allocated to more speculative and active trading. And we spend a very large percentage of our time here at OptionsPlay teaching you how to manage kind of the active side of your portfolio, what strategies work, technical analysis, how the mindset and psychology that you need to have in order to manage active positions in a fast moving market. We spend a lot of time focusing on kind of the strategies and tips for trading your active portfolio. What we don't spend a lot of time here, at least here at OptionsPlay, is talking about your long-term investments. And because these are things that you typically buy and hold in your portfolio, you're not doing things very actively. It's a different strategy for managing this type of portfolio. And it's not typically the type of work that OptionsPlay here does. However, for the vast majority of your wealth that's held in these longer term investments, that is the portion of the portfolio that we want to talk about today, because this is really where most of your risk is actually taken in the markets, because that's where most of your wealth is typically held. And we want to talk about how you can add yield to this portion of your portfolio for your buy and hold investments, typically for an additional 1 to 2% in additional monthly income again, in addition to the dividend yield that you're already collecting on that portion of your portfolio. Just to put that into context, the S&P dividend yield is about 1.5% per year. We're talking about somewhere in the 1.5% range per month with these types of strategies. That's how big of a difference generating income using options versus generating income through dividends can actually be. And when we go through some examples, you'll see comparing side by side how big of a difference dividend yield is versus income yield is from a covered call. And generally speaking, when we're in a higher volatility environment, this favors option selling and reduces portfolio volatility. That's another important reason why, as market uncertainty and volatility picks up, this is the time that you might want to consider embedding these types of strategies into your portfolio. Does that make sense, everyone? Please type 1 into the chat window if that makes sense to you. Okay, perfect. So my goal during today's session is to make sure that we empower you to grow your account consistently and confidently. And like I said, income generation is at the foundation of being able to consistently grow your account. By adding income, you're going to get some downside protection to your portfolio, and it's going to help you increase your probability of success on your long-term investments. So I'm going to show you some examples of how to do so. And this also has the sort of secondary effect of providing some risk management and profit-taking opportunities for your portfolio, because as you generate income, that's going to reduce your portfolio volatility. That's going to improve your risk-adjusted returns. And in the instances where the stock rallies sort of unexpectedly, when the stock makes a big move in a short amount of time that you actually didn't expect to happen, what this gives you is that opportunity to actually take profits from those unexpected rallies that may happen in the different stocks and ETFs that you own in your portfolio. So when we talk about portfolio income, there's really 3 things that we have to consider. First is how to generate a consistent income stream. Anyone can generate income using covered calls. But what we're talking about here is the consistency of it. That's how you're going to be able to consistently grow your account in the long run. And this comes with just understanding the strategies and the best practices to add consistent yield. How do you choose the right expiration date? How do you choose the right strike price is really at the core of generating income stream, which is a combination of how do you enter and how do you manage these trades. And we're going to talk about both. Second is reducing portfolio volatility. When you generate income in your portfolio, this has the secondary effect of reducing portfolio volatility, because the income stream will offset the cost basis of owning the stock. So the more income you generate, the lower the net cost basis of your stock or ETF positions are going to be. And that's going to dampen the market volatility that comes with a higher income stream. But I think the challenge for a lot of investors with selling covered calls in their portfolio are the trade-offs that happen. What I mean by that is that you have to trade something off for that additional income. What you're doing is you're trading off upside. And it's this trade-off that most traders struggle with, is how much do you trade off for how much income? And we've done a lot of research on this one very specific problem in terms of how can you maximize your income while minimizing that trade-off, or rather, what is the right balance between the two that you should shoot for that's going to give you the best long-term results in, using this type of strategy. And this is really where, from our perspective, it's very black and white. There's no ifs or buts. There's a very clear answer to that question. We'll share that answer with you, and we'll show you, more importantly, how to automate it. Okay, so that is at the foundation of why you should consider generating income for your portfolio. Does that make sense, everyone? Please type 2 into the chat window if that makes sense to you. Perfect. So let's just quickly review what a cover call is. I'm presuming that you have some foundational knowledge. If not, you have already sold a cover call in your portfolio. But for those of you that are brand new, let's quickly review what a cover call is. And I will point you to some more resources if this is completely brand new to you and you need a little bit more education before you can implement this type of strategy. So a cover call is a strategy for any stock or ETF that you own at least 100 shares of. So you own a lot of stocks or ETFs in your holdings, right? As long as there's a stock or ETF that has options on it and you own at least 100 shares of, this is a position that's eligible for you to potentially generate additional income on your portfolio. Make sense, everyone? Please type 3 into the chat window if that part makes sense to you. Stocks and ETFs that are optionable, that you have at least 100 shares of. So you have 50 shares of one stock, not eligible. You must have at least 100 shares of an optional stock in order for that stock to be eligible to help you generate additional income. What you're going to do on the stocks that you own at least 100 shares of that are optionable is you're going to sell a call option against that position. And what the call option allows you to do is collect income, because someone else is buying that call option. That person is paying you the premium for that call option. And that's going to generate a specific amount of income for you in order to obligate you to potentially sell the stock at a specific price sometime in the future. So what you have to determine when you sell a call option is what price are you willing to sell the stock at, and at what time in the future are you willing to make that how long you're willing to make that commitment for. And the strike price and expiration date will determine how much premium or how much income you're going to collect. So what you effectively have to do is select a specific price in the future that you're willing to sell the stock that you own at within a certain amount of time, and that's going to determine how much income you can collect. The closer that price is to the current price of the stock, the more income you're going to generate, and the further out in time that the buyer has in order to exercise that contract, the more income you're going to collect. So you have to make a choice as to how far out in time do you want to go, and how far out of the money are you willing to let go of your stock. And these two components are the important components that determine how much income you can generate. But once you've determined a specific price and a specific time frame, that determines how much income you're going to generate on that trade. Once you've entered that contract, you are now obligated to potentially sell the stock at that price on or before the expiration date if the buyer of that call option chooses to exercise that right. Now, that sounds like a mouthful and that sounds like very complicated, but if we break it down, it's going to be quite simple, because the one thing that you notice that the obligation that a cover call forces you into is the same obligation that you take on when you place a limit order. When you place a limit order, let's say you own the stock at $100 and you place a limit order to sell the stock at $110. What does that do when you place that limit order? It obligates you to sell your stock at that specific price sometime in the future if the stock reaches that price in the future. You are effectively taking on the same type of obligations when you place a limit order as you do when you sell a cover call. The difference is that a limit order doesn't pay you any income for placing that order. A cover call does. Now, it's not apples to apples comparison, but the obligation is identical. The difference is that a limit order gets filled immediately if the stock hits that price. A cover call, the stock needs to be above that price at expiration, typically for the option buyer to warrant the option buyer to exercise that call option. So there's a little difference in nuances in terms of when that will actually be executed, but the obligation that you take on is exactly the same. So if you've ever placed a limit order to sell your stock, you are actually very familiar with the obligations that you are taking on as a cover call seller. The difference is one pays you income and the other one doesn't. Does that make sense, everyone? Please type 4 into the chat window if that makes sense to you. Perfect. And if you feel that you're still not quite getting it, we'll go through some real examples, and that will help you, hopefully help you better understand these strategies. So let's talk a little bit about these best practices. So let's first talk about when and when with regards to selling a cover call. Generally speaking, you want to sell a cover call when you have a neutral short-term view, but a bullish long-term view on a stock or ETF. That's our kind of, that's your, I would say, best time, if you will, to sell a cover call. Because if you sell a cover call that obligates you to sell your stock at a higher price, think about placing a limit order that for argument's sake, you don't think is actually going to get filled. What you want to do is you want to get paid to place this limit order that you don't think is going to get paid, you don't think is going to get filled, so that you can collect the income. That's kind of your best case scenario with regards to selling a cover call, right? Because you own the stock, you don't think it's going to appreciate in value, so you're just hanging on to it, and you don't think you're going to make much money from a capital appreciation perspective. So why not bring in some income so that as you're holding on to the stock that you don't think it's going to make a big move in the short run, you at least collect some income. Does that make sense as to why neutral view is kind of the optimal time to sell a cover call? Please type 5 into the chat window if that makes sense to you. And you're going to obviously do this on stocks that you own 100 shares of an optionable stock or ETF. So when you sell that call option, you're obligating yourself to sell that stock at a specific price sometime in the future. Now, this is really where it gets to the point of figuring out what expiration date and strike price makes sense. Now, this is really where we've done a lot of back testing. We've tested every single S&P 500 stock for the last 20 years to figure out what expiration date, meaning how far out in time should you go with selling a cover call, and what strike price should you specifically choose to sell your stock. And our backtest shows that you generally want to go out about 45 days from expiration as a starting point with your cover calls. And the reason for this is because you want to sell a relatively shorter dated expiration, but you don't want to sell expirations that are very, very short, because very short dated expirations have this added gamma risk. That's what works against you as a short option seller. So what you want to do is you want to maximize time decay. You want the value of the option to evaporate to zero as fast as possible, but you want to avoid the last 3 weeks of a short call or put, because that's really where you have the most delta risk, right? That's really on where you're taking on the biggest risk. So you're trying to find this balance between where do you get this acceleration and time decay, but you don't have an exorbitant amount of risk on the underlying stock. And that sweet spot is between 45 days and about 21 days, which is why when you're selling cover calls, you want to go out roughly about 45 days and you want to hold it, and you want to start thinking about managing it about 2 to 3 weeks out from expiration. So that's why we always start 45 days from expiration. And then when it comes to the strike price, this is really where a lot of traders tend to struggle. And the reason for it is because when you're looking at an options chain, you can pick a specific strike price and it will tell you how much income you can generate. And what we do as human beings is we don't pick it based on the right strike price. We based on how much income we can generate. We look down the chain. Every single number that gets closer to the current price has higher and higher amounts of income. And naturally, we want to seek out the strike price that has the highest amount of income, because why not, right? Why wouldn't we want to take on a higher amount of income? But the question is, what trade-offs are you making for that income? And this is really where, based on our analysis, this is based on tens of thousands, hundreds of thousands of backtests that we have run on this very scenario. It's very clear to us that the best way to select a strike price is to go relatively far out of the money. So far away from the current price of the stock. We typically use about a 15 delta. So a strike price that only has a 15% chance that the stock is going to reach that price by expiration in order to maximize the gains on this specific type of strategy. So we will go through a real example and show you what that actually means. But what that really translates to is basically strike prices that are relatively far away, seemingly too far away. And you're you're asking yourself, why would I accept such a small amount of income in exchange for this type of offset? And this is really where, when we go through some real examples, I will show you what I mean by that. But the goal here is that you have to remember, you own the stock. You own the stock because you think it's going to appreciate in value. And you should always put that as a higher priority over the income you generate on the cover call. I know we're talking about this as an income generation tool, but the most important part is the fact that you own 100 shares of this stock. And because you own 100 shares of the stock, you own it because you think that stock is going to appreciate in value in the future. Don't give up that potential appreciation in exchange for a small amount of income today. And that is the thing that you have to remember when you're selling covered calls. Don't prioritize income. Prioritize the capital appreciation of the stock that you own, and income will, it's going to be there. It's somewhat secondary in nature and has a purpose in your account. But remember, the most important part is the stock or ETF that you hold. Sometimes we lose sight of that when we're focused on the income part. But when we backtest this, when we find that ourselves focused on income, we actually underperform in the long run because we lose sight of the fact that we own this 100 shares and we want those 100 shares to appreciate in value as much as possible going forward. So we have to give the stock the opportunity to appreciate in exchange for a smaller amount of income. Does that make sense, everyone? Please type 1 into the chat window if that makes sense to you. And arguably, this is probably the most important thing that you have to know about covered calls is the mindset that you should be in if you're going to deploy this type of strategy in your portfolio. So let's actually jump into the OptionsPlay tool, because I think at this point, we've done enough theoretical application, or rather theoretical learning, and academic learning. I think the next step really is to put this into practice and show you some real examples that's going to help you understand what we're learning here today. So what we're going to do is we're going to log into the OptionsPlay platform, and under the ideas section, now we typically will look at technical ideas for if you're trading, if you're swing trading and you're looking for bullish or bear stocks. That's really where you look for technical ideas. But if you click on the drop down, we have ideas that are suited just for covered calls. And what this does is it shows you the entire universe of very liquid and somewhat liquid stocks that you have opportunities to generate covered calls on. Right now, we have 345 opportunities at the moment. And what we do is we sort it based on yield, meaning which covered call opportunities are going to give you the highest amount of yield and work your way down. However, like I said, the requirement for selling covered calls is that you must own at least 100 shares or 100 shares of a specific optionable stock. So what you really don't want to do is have to look through 345 names. What you want to do is really narrow it down to the stocks that you own in your portfolio. And that's really where we have this tool where you can simply click on a single button and look at the covered calls that are in with the symbols that are in your portfolio. Now, you can set up multiple portfolios in OptionsPlay. You can link your portfolio from TD Ameritrade. We have multiple other brokers coming down the line that will help automate that process for you. Or you can just look at stocks that are in your watch list as well. So you can do this either way, either stocks that you currently have in your watch list or stocks that you have in your portfolio. So let's say we look at the 6 stocks that I have in my portfolio right now. What it does is it ranks the opportunities from highest to lowest in terms of yield. Okay, so let's take a look at Amazon. Let's say I own 100 shares currently trading around $140. By clicking on it, what it does is it calculates for me the exact expiration date and strike price that makes sense for me. So here, as you can see, it goes out immediately to the December 22nd and tells me to sell at around the 152.5 cover calls on Amazon. Amazon's trading at around 140 right now. So this is a cover call that's around 12.5 bucks out of the money. So the stock would have to rally above 152.5 by the December 22nd expiration in order for this, for me to sell the stock. Now, let's take a look at this. Amazon, if I own the stock, pays me 0% in dividends, right? It's a stock that doesn't pay me dividends. By selling this cover call, I'm generating, in this particular case, 7.35% annualized. Let's look at a different number first. Let's look at the 0.84%. What I'm generating is 0.84% of the stock's value in roughly 43 days. So it automatically selected a strike price that is an expiration date that's roughly 45 days out. So December 22nd is the closest expiration to that. And it automatically selects a strike price for me that has roughly between a 15 to 20% chance that the stock will be above that price at expiration. Note that the probability of expiring worthless on this particular trade is 81%. There's nearly a little bit more than a 4 out of 5 chance that this cover call will expire worthless, and I get to keep the 84 basis points or the 0.84% value in the next 43 days. Now, if I'm able to collect 0.84% of the stock's value in 43 days, that annualizes the yield out to roughly 7.35% on a stock that today pays me 0 dividends. That's how much income I can potentially generate on a stock like Amazon. Remember, the S&P 500 pays 1.5%. So on average, if you have a broad-based portfolio, you're generating somewhere between 1.5%, probably 2%. Here, you're generating 7.5% nearly on a stock that currently does not pay you any dividends. So this just gives you a very quick way for you to not only understand what expiration date, what strike price to choose, but also automate the calculation so that you can quickly understand how much yield you could potentially generate on a trade like this. And the tool is designed so that you can quickly go down a list of stocks. Let's say I'm looking at my Alphabet position. I own 100 shares of Alphabet. Let's see how much yield I can potentially generate on Alphabet. So, when I clicked on it, what it does is it automatically pulls the 45 days, roughly 15 to 20 delta cover call for Alphabet. That's December 22nd, 141 calls. And this will generate 0.63% in the next 43 days. Alphabet also does not pay a dividend. So if I own the stock, I'm getting paid 0 in exchange 5.5% annualized yield on this particular stock. Now, one thing to look out for is that I'm selling, in this particular case, the 141 call. So let's take a look at that. So the stock would basically have to return back to its prior highs, the all-time highs. The stock would effectively have to exceed its all-time highs by the December expiration in order for me to effectively sell my stock at that price. And if that doesn't happen, there's about an 85% chance that it's not going to happen. But if it does happen, I'm going to collect, if in the 85% chance it doesn't happen, I'm going to collect 5.5% yield on my Alphabet stock. And in the roughly 15% chance that it does happen, well, I've now sold my stock at the all-time high price. And this is really where a lot of traders struggle, right? A lot of traders will say, damn, the stock made an all-time high. It kept going higher. I could have made more money. But, that's really, you can only think about that in hindsight, right? You can only think about like, hey, I could have made more money, but you only know that in hindsight. You don't know that at the time. So from my perspective, when I can sell my stock at an all-time high, I'm happy with that opportunity that I can basically get out at an all-time high and basically take my cash that I've now earned that I didn't think was actually going to happen. I didn't think Alphabet was going to get back to a new all-time high. And I can now take that cash and reinvest it into a new stock, right? I could buy more Alphabet stock if I really wanted it, if I really thought that this can continue to move higher. There's nothing stops me from taking my cash and buying more Alphabet stock. But I can at that point perhaps say, I've made my gains in this particular stock, and now it's time for me to roll that into a new opportunity. And that's another mindset that you have to be in when you're selling covered calls, is that this is an opportunity to help you exit your stocks when the stock makes a big move in a short amount of time that perhaps is unexpected. Well, guess what? When these unexpected big moves happen, you can take profits. You can realize those profits and then roll those realized profits into the next investment opportunity. Does that make sense, everyone? Please type 2 into the chat window if that makes sense to you. Someone asked about what APY means. That means annualized yield, right? So we're looking at what is the yield in annualized terms to help you compare this apples to apples, okay? I'm going to take a look at some other stocks. Let's say you own GM, right? Let's say you own 100 shares of GM. I'm going to take some lower price stocks just so that, a lot of times you might be more inclined to have 100 shares of the stock. Let's say you own 100 shares of GM. It's not particularly doing that well at the moment. You're generating, in this particular case, 1.31% yield per year. If you were to sell the December 22nd $30 cover calls, that's up here, currently trading at $27. If you sell the $30 cover calls, you can generate, in this particular case, 1.1% in 43 days. So just to put that into perspective, you're getting 1.3% per year from the stock, but you can generate 1.1% in 43 days. So you can generate nearly the same amount of income in 45 days as you do over the full year holding on to this stock. That's how much income you can potentially be missing out on by not utilizing a strategy like this. And because it's not doing particularly well, if it does have a nice rally, a 10% rally, over 10% rally to that $30 mark by that December 22nd time frame, well, you get to realize those gains and you get 1.1% additional income for that time frame. Now, like I said, this has about an 85% chance that the stock will not be above that specific price. So you have about an 85% chance you're going to keep your 1.1%, and you want to keep doing this month after month. And if you keep doing this month after month, you're going to be able to generate that additional yield that you want for your overall portfolio. And we make it as easy as possible for you to quickly identify the stocks that you own at least 100 shares of and which cover call to sell specifically on that. So Freeport-McMoRan, you generate 0.89% in terms of yield per year. Here, you're generating almost the identical amount of yield in just 43 days. So you're effectively doing nearly, in this particular case, 45 days, annualized throughout the year. You're able to do that roughly, let's just call it conservatively 6 to 7 times. You're generating 6 to 7 times the yield on Freeport-McMoRan versus the dividend yield that you earn by selling cover calls rather than simply just holding onto this particular stock. And look at this particular strike price. It's $38. So the stock has to make a pretty big rally here, and nearly a 20% rally in the next 45 days in order for this stock to be called away. And I always tell investors, if you can make a 20% return on the stocks that you own in your portfolio in 45 days, you're going to be a pretty happy camper, or at least you should be a pretty happy camper. And this gives you the opportunity to do that. And if it doesn't happen, which most of the time it won't, you're going to generate a nice amount of yield just holding on to the stocks that you own. And in the whatever reason, and some great news comes out, something happens, and the stock rallies substantially higher than perhaps you originally anticipated, now you get to realize those gains, and you now take those realized gains and roll it back into new investment. And that's on the basis of the wheel strategy. But we're not here to talk about the wheel strategy. We're just talking about this foundational strategy that's going to help you grow your portfolio in the long run. Does that make sense, everyone? Please type 3 into the chat window if that makes sense to you. And we're trying to make this as easy as possible for you. So there's no manual work. You don't have to pull up an options chain, figure out what expiration date, what strike price, how much yield you have to collect. We try to automate as many steps for you as possible, as long as you maintain a portfolio with us or maintain a watch list of the stocks that you hold in your portfolio. The cover call ideas generation will automate all of the work for you. It tells you exactly what expiration date, what strike price, how much yield to generate, and you can click on the trade button and enter this trade into your broker's platform, or you can even paper trade this portfolio into your any portfolio that you set up here at OptionsPlay. So let's say I'm looking at selling this particular position here on Freeport-McMoRan. I select the portfolio that I want to create. I select the portfolio that I want to add it in, or I can create a new portfolio and simply click on add position. And now I can track all of my positions in my portfolio using OptionsPlay as well. So if I look at my cover call portfolio, I can see how all of my cover call portfolios are currently doing, and I can even get alerts on things to do, such as taking profits on rolling my cover calls and things like that. And this is on the management side, which I'll take a couple of minutes and walk you through this example. Okay, but our tools are designed to help personalize the cover call opportunities based on the holdings that you have in your portfolio and automate all of the steps that I just taught you here before with how to enter a cover call. Okay, now let's talk a little bit about closing out a cover call, managing the cover call, because you have to do both in order to consistently generate income, right? You have to be able to enter and exit with a fair amount of ease in order for you to consistently do this week after week and month after month. So let's talk a little bit about once you're in a cover call, what do you do? So generally speaking, there's two things that will happen, right? Either the stock will move in the direction that you would like it to, or it doesn't, right? And if, let's say, the stock doesn't move in the direction you expect it to, then the stock starts moving lower. Well, the short call that you've sold will actually gain from that move, meaning you're going to gain income from the stock either not moving or moving in the opposite direction that you expect it to. So generally, the rule of thumb is that once you've made 75% of the potential premium on a cover call, you can look at taking profits and simply sell a new cover call. That's the rule of thumb we typically use, 75 to 80%. Once you've captured that amount of premium, it's about time to consider closing out the cover call and looking at selling a new cover call. You basically close out the trade and you go back to this particular setup. So once you either, let's say you choose to take profit because you've hit your take profit, you basically go back to step two, right? You just repeat this over and over again. And sometimes most of the time you're going to be able to take profits. Sometimes the trade doesn't go in the direction if the stock goes in the direction you expect it to, and the stock is now trading above the strike price of your cover call, this really leaves you with two possible choices. The passive choice, which is something that I continuously try to convince investors that the passive choice is a great choice because you've now realized the gains that you were hoping for when you bought the stock. So just letting the stock get called away is a perfectly reasonable thing to do. And it's the path that requires the least amount of work because you don't have to do anything. At expiration, the stock is above the strike price that you've sold. The stock that you own will be transferred out of your account and you realize the gains on that trade. Now, if let's say you're in the camp where you feel that there's more upside, right? Now the stock has rallied 10, 15% in 45 days. You think that there's a lot more coming. What you can do at that point is you can simply buy back the call option that you've sold and basically hold on to the stock. You can choose to sell more cover calls, or you can choose to leave it uncovered. I'm in the camp that even if you choose that there's a further upside, that you still sell cover calls because that's going to get more income because the stock can very much rally and make a pullback. And what you want to do is you want to maybe generate some income on that pullback. But that's your choice. And you have a lot of variations as to what to do when the stock goes in the direction that you expect it to. But regardless of whether you choose to whether you choose to buy back the cover call or you hold on to it, if you end up in a position where you're selling another cover call, you basically always revert back to step two. You basically always revert back to going out 45 days from the time that you're evaluating it again and choosing that roughly 15 to 20 delta, a strike price that has a 15 to 20% chance the stock will be above that price at that expiration. And that is how our platform helps you choose the right expiration date, the right strike price to give you that consistency. Because when you use a delta-based approach, you're going to roughly have that 80 to 85% chance that the stock, the cover call that you sold will expire worthless, and you get to keep 100% of the premium or the income that you collected on that. And the OptionsPlay tool not only helps you enter the trade, but also helps you manage your portfolio. So here is a bunch of cover call positions that I have put into this particular portfolio. And what it can also do is give you alerts. So in this particular case, I have one alert to take profits. This is an Alphabet cover call that I originally sold the November 17th 150 calls that expires in 8 days. If you look at the details on this particular trade, I originally sold this 150 call for $1.50. It's now trading at 2 cents, telling me that it's time that I can take my profits. Even though there's 8 days to go, I probably want to roll this cover call, looking at selling a new one. And this really goes back to my ideas, right? I would go back to Alphabet, go to my portfolio, and I would look at what would I want to sell next on Alphabet. And we already went through Alphabet as an example, but let's say I bought back that November 150 call. Now what I would do is I would sell the December 22nd 141 call and generate, in this particular case, 63 basis points over the next 43 days. That's going to generate another roughly a little over 0.5% of the stock's value in 43 days. So basically, the portfolio tool helps me stay on top of my positions, helps me know where there are positions for me to take profits on, where, how much profits have I made. And this allows you to also keep tabs on your overall position. Something I sold for 25 cents is now trading at 11 cents. So I'm up in this particular case, 56%. As you can see, my unrealized gain on this cover call is 56%. So it's nearing my take profit levels, but it's not quite there. I have an Amazon one that I originally sold for $250 that's now trading at $244. So it hasn't moved a whole lot, and there's only 8 days left to go. So this is one that I probably want to think about rolling, especially since I'm very close to the strike price. I have the choice of either saying, okay, I'm happy taking profits at Amazon at 140. This was a $130 stock 2 weeks ago. It's now trading at 140, or rather $120 stock a couple of weeks ago. It's now trading at 140. Do I want to take profits on it and get out? Perhaps I do. It's rallied quite a bit over the last couple of weeks, unexpectedly on earnings. Let me realize some of those gains and move on, perhaps. Or if I think there's substantially more upside, then I want to simply buy back this 140 call and look at selling a new one. And this tool helps me automate the full life cycle of getting into a cover call and then managing that cover call using the OptionsPlay tool. So I'll leave you with a couple of tips on trading strategies. First of all, focus on stocks that you're familiar with and comfortable investing in. Don't buy a stock just because it has a high cover call yield. The yield on a cover call is not enough to offset the risk that you're taking on the underlying stock itself. So you always should start with the stock that you are familiar with and comfortable with investing, and only if you've determined that and purchased the stock on those bases do you want to look at selling a cover call. You simply want to have high yielding income, sort by the yield. We have that yield sort. That's the default sort on the cover calls. That's where you should start with regards to finding opportunities. If you have a relatively small account, sort it based on stock price. This will allow you to focus on lower price stocks for finding yield. And lastly, there is an earnings flag. This tells you when you're looking at opportunities in the cover call ideas or any other ideas, as you can see, which ones have earnings coming up and which ones don't. And this will allow you in certain cases to potentially avoid something with earnings if you don't want to trade something with earnings. So for example, Accenture reports earnings within the 43 days. Perhaps you might want to avoid this. I actually, in this particular case, generally don't use this earnings flag, but for some, you might want to. And this earnings flag helps you quickly identify opportunities, and you know exactly which ones might be worth your time or worth looking into without even necessarily having to click on it first. You already have most of the relevant information here in this screen, but once you're ready to kind of dig deeper, you just click on it and all of the rest of the information will populate here on the right-hand side, which is predominantly around what expiration date, what strike price, and how much yield are you collecting. Those are really the big data points that you need to look at. And we've automated all of those for you, selecting the expiration date, selecting the strike price, and calculating the yield so that you make a decision within a few seconds, as opposed to, the 10, 15 minutes that perhaps used to take in order to place these types of trades, or rather do the research to place these types of trades. So to wrap this up, this is a strategy that should be, like I said, at the foundation of every investor's portfolio. Even if you're not particularly interested in options, or maybe you haven't even thought about options from this particular perspective, and you've been trading debit spreads, credit spreads, iron condors, butterflies, and you've been trading directional strategies, but you have a large percentage of your wealth in long-term investments in stocks or ETFs, you should reevaluate whether or not these strategies belong in your portfolio. Because if you can generate an additional 5%, additional 7%, additional 9%, and these are really conservative examples that I gave you today. I didn't even go through the examples where you can generate 20, 30% income on your portfolios in those sort of more volatile stocks. but very conservatively, 5, 7, 9%. We're talking about 2, 3, 4 times the dividend yield that you're currently generating on your portfolio. What's an extra 5% a year, an extra 7% a year going to do for your portfolio in the long run? I would argue it does a lot. And 5 to 7% doesn't sound like a whole lot, but it really adds up in the long run when you're able to do it consistently. And our platform has been designed from the ground up to try to help you do that as much as possible and automate as many of the steps as possible. So if you don't already have an OptionsPlay subscription or signed up for OptionsPlay, you can sign up for a free 30-day trial using the link on your screen, or point your phone to that QR code, and it's going to give you access to the platform that I showed you today, as well as the recording and slides for today, so that you can follow along at your own pace. Make sure you fully understand the strategy before you start implementing it in your portfolio. So hopefully this is helpful for those of you that are new to options. Hopefully this is helpful for those of you that have been trading options for a while, but perhaps not realize how much income you are missing out on by you not utilizing these types of strategies. And especially in the interest rate environment that we're in, you can generate a lot of income these days from the different products that are available to you. So let's open this up for Q&A. There is a Q&A window and a chat window. If you can please type your questions into the Q&A window, we'll try to answer as many questions as possible before I have to sign off during today. How do I get out of the deeper in the money cover call over 140 in the money and 6 months away? First of all, I don't think you should sell a cover call that's 6 months away from expiration. That's why you want to go 45 days from expiration. How do you get out of it? I don't know that there's anything, there's no magic to getting out of it, right? Either you have to buy it back and accept the loss that you have to take to buy it back, or you hold on to it. Those are your only two choices. What you can change going forward is the expiration date and strike price that you use going forward, so that you don't find yourself in a similar position going forward. Generally speaking, if it's deep in the money, you don't have a lot to benefit from holding on to it, right? Because extrinsic value left in an in the money cover call or deep in the money cover call. And I'm assuming that you're in a deeper in the money cover call, not because you entered it as a deep in the money, but it traded up there, right? I hope that you didn't enter a deep in the money cover call. Never, ever, ever, ever sell a cover call that's in the money. Always sell an out of the money cover call. Can you comment about selling cover calls with 1 week's to expiration every week versus a 45-day approach? Absolutely. The question is, should you, in certain instances, let's go back to our Amazon example. The question is, should you sell weekly options? And theoretically speaking, right, like I can generate in this particular case $1.17 by selling a 43-day option, If I were to sell a 1 week option, right, how much can I generate? We'll go roughly to the same, let's call it a 20 delta. I can generate 54 cents, right? So I can generate just under of the premium in 8 days as I do in 43 days. And it sounds like on paper that I should be selling weekly options, because I can generate, in this particular case, 0.39%, which annualizes to 19%. And that sounds really great, right? But you have to remember, when you're doing this weekly, you're going to have a 4 out of 5 chance every single week that the stock gets called away. And you are basically limiting yourself to, in this particular case, to only $3 in upside. So basically, every single week, the maximum gain you have in the upside here is about $3. That's really where you're going to sell yourself short in the long run, because 1 week's a $10 move. Guess what? You don't get to capture it. And you've captured such a small premium in this particular case, only $54 worth of income on a $14,000 position, that if, let's say, 3 weeks down the line, the stock gets called away, you've made a total of maybe $150 in income, and you've given up a lot of your upside in exchange for that, which is why when you're selling cover calls, do not sell weekly options. Theoretically, you make more money, but practically speaking, you are going to be far behind selling weekly options on cover calls than you do with with 1.5 month out. If you want to sell weekly options, sell straddles, sell iron condors, sell butterflies. Those are the types of strategies that perhaps if you want to sell weekly options, you want to do that once a week. But certainly not cover calls, because you're not getting enough income to offset the substantial amount of risk that or the substantial amount of upside that you could be giving up, if the stock does make a big rally in a short amount of time. Hope that answered your question. And I think it's a pretty common question, Lewis, and I'm glad that you asked that. What should the stop loss for the stock and then the cover call is closed? Great question. So the question is, what if I sell this cover call on Amazon, the stock drops, right? That is a tough thing for me to help you answer. Generally speaking, you should be thinking about your stop loss on stocks as, at what point would you say I'm no longer bullish on the stock, right? At what level does Amazon need to break down below for me to say I'm no longer bullish on the stock? Looking at this chart here, I'd say that's somewhere around maybe 124 or so, right? As long as it stays above 124, I'm arguably neutral on Amazon, right? But once it breaks below 124, I'd say, hey, my views here of this continuing its trajectory to the upside clearly is not working out. Perhaps it's time for me to cut my losses and move on. So I would say it's more based on technical levels for me than it is based on a percentage level. But basically, at what point would you say I'm no longer bullish on the stock? Then you should get out of the stock and buy back your cover call. Couldn't you roll out and up if it looks like strike price will be breached? Absolutely. That's what we're saying, is that if you feel that the stock strike price will be breached and you want to continue to participate in the upside, you have to manage it by rolling it up and out. Can you look at Comcast? Let's take a look at Comcast. I'll look at a couple of examples here. And we're going to go out to the short, medium term conservative cover call, which is the default. So as you can see, 85% probability of profit. Comcast earns 2.75% annualized yield. This cover call will still generate 4% annualized yield versus the 2.75%. So from my perspective, as long as you're beating the dividend, I generally try to at least double the dividend when I'm selling a cover call, and you're a bit shy of that. So this is kind of, I would say, on the cusp of whether or not it's worth it or not, in my opinion. I'd say this is kind of the bare minimum that I'm typically looking for in terms of yield to justify the offset that or the trade-off that I'm making of selling the stock at a specific price in exchange for some upside income. There's a question here, a fairly involved question about your very specific strategy on buy rights of selling, 1 week options and selling 1 week cover calls. Do I think it's a good strategy? If you don't mind, I'm happy to answer your question, but that's a bit more involved. Send me an email at info@optionsplay.com and I'll try to answer your questions. What's the difference between the annualized return and 12-month projected yield? The 12-month projected yield basically is this number, 4.03%, plus the 2.75% that you get up here is how we generate the 6.78%. So the projected yield basically takes into account what you're going to earn on the cover call and what you're going to earn on the dividend and adds the two together. What is POW? Probability of expiring worthless. What is the probability that this call option, the December $44 call option, will expire worthless and I get to keep 100% of the premium or the income that I collected on this cover call? How do I manage such a situation? Sorry, Nayab, your question is about a credit spread. I'm happy to answer that question, but please send me an email and I'll try to answer that question. How do I delete stocks from the watch list? So when you go to watch list, If you select a stock, you can only delete stocks on a watch list that you've created. You can't select any of the global watch lists. So any personal watch list, let's say you look at your personal watch list, you click on the pencil button, and you can click on delete next to any specific symbol that you want to delete. So you have to select one of your watch lists that you created, any personal watch list. If you click on it, you just click on the pencil button, and you can have a delete button next to each one. How do I set the earnings alert? You don't have to set anything. So if you just go every single cover call opportunity or any idea will tell you whether there's earnings between now or expiration. Does the OptionsPlay tool flag if we choose a strike date that is beyond the dividend or earnings event? We certainly tell you if there's an earnings event, right? Because that we have an earnings flag. So if you choose an expiration date and there's earnings. In terms of dividends, the dividends doesn't affect the options price, or rather the dividends are already baked into the price of the option. So which is why any yield calculations that you have here is already accounting for the dividend. If your goal is income, what about using a put credit spread instead of a cover call? So a put credit spread is a variation of a cover call from my perspective, right? Or gives you a similar risk profile. It is a more advanced strategy. You do have to have level 3 options in order to be approved for it, and it's more speculative in terms of nature by that. Which is something that we plan on covering, and I have covered credit spreads extensively. But this session that I'm trying to cover is specifically for the stocks that you own, right? You can still sell put credit spreads in addition to it, but that doesn't stop you from owning stocks that you already have in your portfolio. So what we're saying is that you have all these stocks in your portfolio that you are holding on to, that you're hoping will appreciate in value, and you're generating hopefully some income on it. But how can you add additional income to assets that you already own? And then you can sell put credit spreads in addition to that as well. Is there a specific option liquidity requirement to use this strategy? Yes. I don't suggest that you sell cover calls in something that's not liquid. Anything that's very liquid or somewhat liquid, which we have an indicator here for any symbol that you type in, liquidity, liquid or somewhat liquid is the bare minimum that you need to sell a cover call. Do you suggest selling a cover call on a stock that is underwater in your portfolio? Really good question. Part of it kind of depends on how far underwater you are. If you're underwater by a little bit, the answer is absolutely. If you're underwater by a lot, I'm still an advocate for selling cover calls. A lot of people don't like to do that for obvious reasons. But I think that the more underwater you are, the more you might possibly need that income. But at the same time, if you're underwater by quite a bit, I usually tell investors you should be thinking about to yourself, not whether you want to sell cover calls, but should you continue to hold on to that stock? That's a much better question to be pondering, because if you're underwater by a lot, that's sort of not only do you have to consider the trade itself, but also the opportunity cost for the capital that you're tying up in this trade that's obviously not working out. So I think that, underwater, it's a great question, but it's really more of, do you want to still hold on to that stock? Can we look at NVIDIA? I'll look at one opportunity here on NVIDIA. So let's say you own 100 shares of NVIDIA, which is obviously an expensive stock to own 100 shares of. You need about $46,000 in this particular case. So NVIDIA obviously pays virtually zero dividends. I actually don't know why they bother paying 16 cents in dividends on a $500 stock, but they do, which comes out to be 3 basis points. Here you're generating 10.72% annualized. That is an 88% chance of expiring worthless. So nearly a 9 in 10 chance that this cover call will not get called away. $565. That's well above the 52-week high. So the stock has to rally above $565, which is all the way up here. In exchange, you get a nearly 11% yield. So if you do happen to own 100 shares of NVIDIA, I certainly think earning 11% a year is a pretty good yield to have. And if the stock was to rally that much in such a short amount of time, you effectively take profits. I wouldn't be upset with either one of those two outcomes, either earning 11% or being able to take profit on this stock when it rallies that high of an amount. That's the way I'm looking at it. How do I filter the cover call report? Great question. So out of the 345 opportunities, you can do filtering, right? So you can say only show me ones that have no earnings, IV rank that's greater than equal to 50%, that's at least somewhat very liquid, and only show me certain yields, right? I'll leave that for now. And basically that will basically help you sort through the ideas. But like I said, with cover calls, you generally don't do much of this filtering because the only filter you really need for cover calls is what stocks do I own? You can only sell a cover call on a stock that you own. But if let's say you're selling a credit spread or a cash secured put, then these filters make a lot more sense, in my opinion. Great question. Maura's asking a great question. So I have this pro tip here saying that use IV rank when it's greater than 50 in order to maximize yield. And Maura mentioned that on Freeport McMoran, at the time when I was looking at Freeport McMoran, the IV rank is 9 out of 10. That doesn't seem like a great time to sell cover calls. And you're absolutely right from that perspective. However, while it is best or most optimal to sell cover calls when the IV rank is greater than 50, what you realize is that if you only waited for IV rank to be greater than 50, then you miss out on probably throughout the whole year. I said that you can probably sell about conservatively 6 to 7 45-day cover calls, right? If you only wait for it when IV rank is greater than 50, you probably can only sell 2 out of those 6 or 7 times throughout the year. And what that means is that you're missing out on probably 60 to 70% of the yield, right? So from our perspective, would you rather miss out on 60 to 70% of that yield in exchange for only selling it when you get, in this particular case, instead of $75 for the 45 days, or rather, sorry, let's go out to the December. I'm generating 27 cents worth of income in 43 days, right? So when IV ranks higher, maybe I'm generating $35, right? Which, or $40 even, which is certainly more than $27. But, by saying that I'm not gonna sell it during this time because it's not the most optimal time, but what you're giving up is 60 to 70% of the income. So from my perspective, IV rank is not an important indicator to look at when you're selling cover calls, because this is the strategy that you want to do all year round, right? You only get the benefit of it if you do it all year round. If you only wait for the best time to do it, you miss out on so much income that you don't really get the benefits of this strategy. So hopefully that helps you understand what I mean, that even though it's the most optimal time to sell when it's greater than 50% in terms of IV rank, you still want to sell at the other times of the year because you don't want to miss out on the income stream. You're just getting a slightly smaller income stream during that portion of the year versus the other parts of the year when IV rank are high. Capital gain tax is a big concern if stock gets called away. You're absolutely right. And here's the thing, from a capital gains perspective, if you think that the stock is about to get called away, right? Or let's say your stock does get called away, you can buy more stock on Monday morning, right? After your stock gets called away, because from a tax lot basis, you can deliver the new basis. You don't have to deliver your original basis from a tax perspective, right? So if you buy stock on Monday or the following Monday, tax lots do not have a first in, first out rule, right? You can deliver any lot from. So that is another tip that, if let's say you have a stock that's called away that you didn't want get called away from a tax perspective, you can buy back more on Monday to kind of offset that tax bill. Why would I roll rather than cover and sell another in two separate trades that I have control over both legs? Because by doing in two separate trades, you have execution risk, right? You can have one, the only way you can efficiently roll is doing it in one order, right? It guarantees that you buy back your old call and you're in a new call simultaneously. If you're managing as two separate trades, well, one, you can maybe buy back the call option, and then the order to sell never gets filled, right? Or vice versa, even worse, the sell order gets filled, but your order to buy never gets filled, and now you're naked of call, right? Now you have a huge margin requirement on your naked call, assuming that your broker even allows you to do naked calls, right? Otherwise, your order won't even be able to get filled until your buy order gets bought back. So they'll just reject the order outright. So that's why you always want to send it in one order as a roll rather than two separate trades. Would it be okay with selling in the money cover calls if the premium exceeds the stop loss? The stock loss? I guess what you're saying is that. Actually, I'm not sure what you mean by the stock loss. If you don't mind clarifying. What are tax implications? The cover call will be short dated, will be short-term capital gains, or ordinary income. But so it is best done in a non-taxable account. Yes. Do you have a strategy for writing a sub-acquisition call when the price of the stock is below where you own it? Do you sit or wait or cut and run? This is a question that was asked earlier, and I think this is the same question, which is, if you bought a stock and the stock is underwater, what do you do with regards to selling cover calls? My take is that you sell cover calls because you could use the income on the stock that you're losing money on. But the better question is, should you still continue to hold on to that stock? And a lot of times you might find yourself where you really shouldn't be holding on to the stock. You're better off taking that capital and applying it somewhere else where the opportunities are greener. Is 60 days too far? No, 60 days is not too far. But 60 days, generally speaking, in my opinion, is the limit of how far you should go out. Okay, that covers what I have time for here today and the questions that you have. Thank you so much for your time this afternoon. I really hope that those of you that joined here today got something out of this. I hope that this was helpful in giving you a better understanding of how much income you should be able to generate using this type of strategy that is overlooked by a lot of investors just because it's not particularly sexy. Hopefully you got some tips on just where to look in terms of generating income, and now you know how to use the OptionsPlay platform to help you automate as many steps as possible and giving you the best chance of actually implementing what you've learned here today. So with that, thank you so much. Have a great trading day. And please, if you're brand new to OptionsPlay, sign up for your free 30-day trial so that you can have access to the tools that I showed you here today. Thank you so much and have a great trading day.